David Orguttery is the Chief Executive Officer of InSource Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgil are financial advisors who represent Emeritas Investment Company, LLC, and Emeritas Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today again by Seth Edgil of InSource Financial Advisors. Seth, thanks so much for being with us. Seth, there's no shortage of headlines right now. Tariffs are back in the news, geopolitical conflicts dominate nightly coverage, and investors are being reminded daily of everything that could go wrong. Many people are feeling uneasy. So how should investors be thinking about current events right now?
That's a great question, and it's very timely. I think the most important thing for viewers to hear today is this. Feeling concerned about current events is natural, but allowing those concerns to drive financial decisions has historically led to poor outcomes for many investors. That does not mean current events are irrelevant. They clearly matter. But from a planning and statistical standpoint, markets have historically incorporated uncertainty more effectively than most individuals expect. While past performance is not indicative of future results, history gives us useful context for decision making.
Well, many people feel like this moment is different. So why do you say worrying about headlines is often unproductive?
Because when we step back and examine long-term data, a consistent pattern emerges. Markets have historically generated returns across a wide range of environments, including wars, recessions, political instability, trade disputes, pandemics, and periods of elevated inflation. According to research from Morningstar and First Trust, U.S. equity markets have historically recovered from bear markets in roughly 2 years on average. That does not mean future recoveries will follow the same timeline, but it does illustrate that volatility has been a recurring feature of markets rather than an anomaly. Additionally, data from JP Morgan Asset Management shows that investors who attempted to time markets around major news events often experienced lower long-term returns than those who remained invested. Missing even a small number of strong market days has historically had a disproportionate impact on long-term results. Again, while past performance does not predict future outcomes, the data highlights the risks associated with reactive decision making.
Well, let's talk about some of the specific concerns that people are hearing about right now, such as tariffs and geopolitical conflict. How should investors interpret those risks?
They should be acknowledged, but also placed in context. For example, during the trade tensions between the U.S. and China from 2018 through 2020, markets experienced periods of heightened volatility. However, according to S&P Dow Jones indices, the S&P 500 produced positive calendar year returns in multiple years during that period. That does not imply that future trade disputes will have the same outcome, but it does show that markets have historically been capable of functioning through similar conditions. The same applies to geopolitical events. Studies published by Credit Suisse and later updated by UBS reviewed market behavior during major global conflicts and found that while short-term volatility often increased, the long-term market trends were not necessarily derailed. Of course, future conflicts may unfold differently, and outcomes are never guaranteed.
Well, election years also tend to increase anxiety. Is that a concern supported by data?
Election years often feel uncertain, and markets do not like uncertainty. That said, according to CFRA research, U.S. equity markets have historically produced positive returns in the majority of presidential election years since World War II, under both Democratic and Republican administrations. That does not mean markets will rise in every election year, and it does not suggest political outcomes are irrelevant. But it does indicate that markets have historically been influenced more by economic fundamentals, such as earnings, productivity, and innovation, than by election results alone.
If reacting to headlines isn't the answer, what should investors focus on instead?
They should focus on what is within their control. No one can control tariffs, elections, wars, or central bank decisions, but investors can control diversification, asset allocation, savings behavior, time horizon alignment, and risk management. A well-constructed financial plan is designed with the understanding that uncertainty is permanent. With my clients, the planning process does not rely on predicting short-term events. Instead, it is built around assumptions that markets will be volatile at times and that plans should be resilient across a wide range of potential outcomes. There are no guarantees, but thoughtful planning can help manage risk more effectively.
Well, you often emphasize behavior, so why is that so important?
Because investor behavior has historically played a significant role in long-term results. According to Dalbar's quantitative analysis of investor behavior, individual investors have historically underperformed the broader market over long periods, largely due to emotional decision-making rather than investment selection. That data does not predict future investor behavior, but it does illustrate how emotional responses to volatility can negatively impact outcomes. A financial plan provides structure. It helps separate short-term emotions from long-term objectives.
If someone is feeling uneasy right now, what would you suggest they do?
I would suggest 2 productive next steps. First, a plan review. This is simply confirming that your strategy still aligns with your goals, time horizon, and tolerance for risk. In many cases, no changes are needed, but the review itself can provide clarity. Second, a behavioral check-in. Sometimes the portfolio is appropriate, but confidence has been shaken by headlines. Talking through historical context, assumptions, and potential trade-offs can help prevent emotionally driven decisions that may not serve long-term objectives. Neither step guarantees outcomes, but both can support better decision-making.
Any final thoughts you'd like to leave viewers with today?
Yes. Headlines are designed to capture attention, not to guide financial decisions. While past performance is not indicative of future results, history shows that reacting to uncertainty has often been more damaging than uncertainty itself. Markets have historically advanced despite persistent concerns. The goal is not to eliminate worry, but to build a plan that accounts for uncertainty and helps investors stay disciplined through it. If current events have raised questions, or if you would like a second opinion on your strategy, that is a conversation worth having.
Seth, as always, thanks so much for joining us. And for additional information, Seth may be reached through the means listed on the following screen. For InSource Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.